Bom dia a todos, pessoal. Acho que a gente já tem aí um número bacana de audiência, então vamos começar por aqui, em benefício do tempo. Primeiramente, meu nome é Marcela Fioli, eu faço parte do time de Sales da Investimentos, que é a gestora responsável por viabilizar os feeder funds da Oaktree aqui no Brasil. Aqui do meu lado, eu estou com meu parceiro da Capital, o Rodrigo Aloy, que é Head de Research da companhia. Primeiramente, eu gostaria de agradecer a todos vocês pela presença. A gente sabe que hoje é muito difícil encontrar uma brecha na agenda, então, muito obrigada pelo tempo de vocês, parceiros investidores, distribuidores. E também não posso deixar de agradecer ao time da Oaktree, que é quem viabiliza esse webinar, e ao David Rosenberg, que é quem vai liderar a conversa hoje. Para aqueles que estão aqui pela primeira vez, esse webinar é parte do nosso processo de pós-venda, de atualização da estratégia Global Credit da Oaktree. Então, a ideia é, de fato, estreitar a distância entre o investidor local e os distribuidores locais do gestor lá fora. Tá? Então, eu vou passar a palavra aqui para o Aloy, para ele comentar um pouquinho como que a gente vai tocar essa conversa.
Bom dia, pessoal. Como a Má falou, meu nome é Rodrigo, eu toco a parte de research aqui da HMC. Acho que ela fez um pouco da introdução do call, do que a gente espera aqui para hoje. Acho que só para dar um pouco mais de cor, a gente vai adotar a seguinte dinâmica. A gente vai dividir o webinar aqui em duas sessões. A primeira vai ser uma sessão em inglês com o David, para que ele possa rapidamente passar um pouco sobre, primeiro, filosofia, processo de investimento da estratégia Global Credit. Depois ele vai passar um pouco sobre as visões que ele tem a respeito do mercado de crédito global, com foco especial no mercado de crédito, tá? Que é o mercado de atuação aí da estratégia Global Credit. Na segunda e última sessão, a gente vai primeiro compartilhar um pouco alguns slides aqui a respeito da estratégia local, coisa bem rápida, a gente não pretende gastar mais de 5, 10 minutos nessa exposição, e depois a gente vai entrar dentro de uma sessão de Q&A para que vocês possam, de fato, interagir aqui com o David, fazerem as perguntas, tanto em relação à dinâmica atual do mercado de crédito global, quanto questões específicas da estratégia ou até mesmo do veículo local. A gente está aqui para fazer uma sessão bem interativa mesmo, e estamos prontos aqui para endereçar todas as perguntas que foram feitas, que forem sendo feitas ao longo do call. A melhor forma de fazer pergunta é usando o chat de Q&A aqui. As perguntas podem ser feitas a qualquer momento, tanto em português quanto em inglês. Então, a gente vai tentar endereçar todas as perguntas aqui ao longo do call. Se alguma passar por conta de falta de tempo aqui, a gente vai ficar feliz em endereçar a pergunta logo depois do call por e-mail. As duas sessões aqui, tanto a primeira do David quanto a segunda de Q&A, não devem durar mais de 35, 40 minutos, então a ideia é fazer um papo bem objetivo aqui, para a gente ir nos pontos mais importantes e, no fundo, não desperdiçar o tempo de ninguém, que a gente sabe que a rotina de todo mundo é mega corrida, principalmente no começo da semana. Sem mais delongas aqui, eu queria apresentar o nosso convidado especial de hoje, e já passar a bola para ele em inglês para dar início. Então, o David Rosenberg, ele é Managing Director e Co-Portfólio Manager da estratégia do Global Credit, e ele também atua como co-gestor, fazendo a supervisão das estratégias High Yield na Oaktree, tá? Eu acho que não vale passar por todo o currículo do David aqui, porque eu acho que tomaria mais tempo ainda. O David tem não só vasta experiência de mercado, como também uma longa trajetória dentro da Oaktree, são quase 20 anos de casa, e sem dúvida nenhuma é uma das principais figuras da gestora atualmente, então a gente está muito feliz de ter ele aqui com a gente hoje. Com isso dito, espero que gostem do webinar. A partir de agora a gente vai passar para o inglês. So David, thank you very much for being here with us today.
Sure. Thanks for having me.
No problem. It's a pleasure for us all, I'm sure. To get started, it would be great to hear a little bit from you. What's your views on the market, especially on the credit part of the market, and also a little bit of the highlights of the strategy, what you've been seeing on this past quarter. Thank you very much. I'll pass the word to you.
Okay. So I think that the theme of the market these days seems to be higher for longer. I think the market has kind of come around to, especially recently with 10-year in the US almost, touching 5%, I think last night. So the market has come around to the reality that rates likely are going to stay here for a bit. And I think that has quite a lot of implications when you think about credit and credit investing in particular. So you think about it, if you go back maybe not quite a year ago, the market was convinced we were going to be in a recession already today. And by the end of this year, rates would be 100 basis points lower. And I think we've had this discussion on previous webinars about how that really never made any sense to us. Because if you think about why the Fed would pivot and why you'd see rates down 100 basis points, what I always like to tell people is the Fed pivots because there's a crisis. Something bad has to happen. They don't pivot just to support equities, even though everyone wants them to. The reality is they're around to support the economy, and the economy and the equity market are not always the same thing. And so you need a crisis. And so this concept that we were going to have a soft landing recession and then end the year with rates 100 basis points lower never really made any sense to me, because if you had a soft landing recession, there's no reason to lower rates 100 basis points. Everything's fine. You had a soft landing. And conversely, if you had rates 100 basis points lower, then there was no soft landing. Something very bad happened. And so we had kind of had this view that rates were going to stick around for some time. You know, if the other way I like to put it is the goal of the Fed was not to touch 2% inflation and then call victory. The goal was to stay at 2% inflation, which means you likely need to keep rates higher for a little bit longer to achieve that. I had this conversation with Howard Marks, our chairman, just recently, where, you know, he was very funny because people have started to use the term new normal, which Howard doesn't like to hear, because, you know, he gets very, very, very agitated and says, look, this is not the new normal. This is the old normal. The abnormal part was zero rates. It just so happened that zero rates stuck around for over a decade and everyone got used to it. But having rates where they are right now isn't abnormal. It's actually quite normal, which means they could stay here. And so what does that mean? Well, if you think about it, in my view, biased as it may be as a debt investor, I firmly believe that means that you're in a position now where debt is going to outperform equities. And that's something that you can't normally say. I've been doing this almost 2 decades, and it's not common. You can say debt's going to beat equities. Debt's not supposed to beat equities. Debt is asymmetric to the downside. Equities has unlimited upside. Structurally, equities should be able to beat debt because, frankly, you're taking more risk when you buy equities. However, if you think about equities in its simplest form, equities need growth, right? You take your growth, you put multiple on your growth, and you value your equities. And over the past 5 to 7 years, we've had tremendous growth because money was free. And it turns out when money's free, people borrow a lot of it. They take all this free money and they go build factories and they go invest in growth plans. You have all this growth. Well, now the very reason that debt is attractive, in my view, is the same reason that equities are less attractive, which is money is expensive. So it's going to be difficult to borrow, which means you're going to borrow less, which means you're going to have less growth. And the beauty from debt is that I don't need growth. I just need companies to generate enough cash to pay me back. And if I can do that, if I can pick the companies that can pay me back today, I get a 10% yield. So I get 10% future return for my trouble. So think about another way to think about this is that for equities to beat debt today, you have to have a return north of 10% going forward from here. And how are you going to finance that with money so expensive? And so I think it's one of these scenarios where it was equally so as clear as it was to me at the beginning of this year that a 100 basis point pivot from the Fed didn't make any sense. It's equally clear that you're in a market now over the next 3 years or so, debt is going to be a better investment than equities. It's quite rare. The other thing about debt, when you think about this, is that we've been through markets where you get double-digit returns. I've seen this a couple of times in my career, but usually it's because everything's really scary. Something really, really bad has happened. And right now, things aren't that scary. You know, people are talking more and more about a no landing versus a soft landing. And maybe this is the first time the Fed can do this and actually avoid a recession. I'm not a believer on that front, but it's possible. But the reality is the fundamentals are strong enough that people can make that argument. In spite of that, we're still getting a double-digit return. And this comes back to the fact that rates have risen and are likely going to stick around. And so that's kind of my view. And I think the other thing that you have to think about, because when you talk about higher rates, the fun part is you're going to earn more for longer. That's great. But you also have to realize that means companies have to pay higher interest for longer. And so in my view, that means credit selection is going to be much, much more important. And so I always like to say in fixed income that we don't need to be heroes in fixed income. The yield's already high if we're below investment grade, and everything we do is below investment grade. So we're already getting a double-digit yield. The key is to keep it and not give that yield back to defaults and to selling into volatility and so forth. And so right for the past 5+ years, credit selection, frankly, wasn't quite as important because in the US, everyone used to like to say they had the Fed put, which was true, frustratingly for people like me, that as long as you didn't sell into periods of volatility, eventually the Fed would bail you out. And it didn't take very long. I mean, think about the pandemic. We had a global pandemic. The entire world shut down, and it only lasted 2 weeks. 2 weeks, and the market was back off to the races. And so as long as you didn't sell for the first 2-week period, the central banks bailed you out. Now, I believe we're in a period where if you do have the quote unquote Fed put, it's a lot lower than you want it to be because central banks cannot fight inflation on one hand and support the market on the other. Those are in direct contradiction with each other. And the central banks have picked inflation, appropriately so, in my view. Inflation is something they need to make sure they have under control. We're noticing inflation getting a little bit sticky, as it tends to do. It's one thing to get inflation from 9 to 6 to 5. It's a whole nother thing to get it down to 2. That's quite difficult, especially with oil prices creeping higher recently. And so that's going to be an effort, but that means that you're going to have to rely on your own homework. You're going to have to rely on your own credit work, which is the markets we root for. So take it with a grain of salt. Oaktree are credit pickers, and so we root for credit picker markets. But I firmly believe this is one we're in now. You know, I've had this conversation with people in the past where I'll pass on a credit and someone else will buy it. So I'll call them up out of curiosity, say, how can you get comfortable with this credit? And they'll say, well, they don't have to finance for 2 more years. And by then rates will be lower and everything will be fine. And so that was kind of the narrative for everyone was you just wait, rates are going to come back down and this will all go back to the quote unquote normal that it was. I think the market's now realizing that that may not be true. Rates may not go back down. And if they do, it's because something really bad happened. And so there's a whole other problem to have to deal with, which means that some of these companies are going to now have to figure out how to manage their balance sheet with interest that is twice as expensive as it was over about a year ago. And that means being able to select the companies that can pay the interest is going to matter. I basically put the companies into 2 categories these days. You have some companies where say it's a private equity sponsor bought the company and took it private. And now they had all these ambitious growth plans and they took money over on the side here to finance that growth. And now, because debt has become more expensive, they have to rechannel that money into the balance sheet. But the balance sheet will work. They're just not going to see any growth anymore. And so the equity investors are pretty upset. I'm okay if equity investors are upset because my debt is still covered and I'm okay. And those are good investments. Now, there's others on the side where they gorged on money when it was free, and now they're not going to be able to finance it, and those companies are going to have to restructure. So the ability to separate those two, to me, is going to be the key to survival going forward. And if you can do that, if you can separate those credits, then you're going to end up with debt that provides you an equity-like return, which, again, is very, very rare. And so that's pretty exciting for me. So that's kind of my view of the landscape. I'll pause and see if there's any questions or from Rodrigo, Marcelo, or anyone else, and happy to take this any direction that's helpful.
Thank you so much, David, for your views. It's always very enlightening to hear your thoughts and how you're seeing the credit markets, especially in this rare environment. So before we jump to the Q&A session, I'd like to quickly share some slides with the audience, just to comment on the local feeder funds and also in the global credit strategy in general. And then we can jump to the Q&A session. If you allow me, I'm going to switch to Portuguese to make it faster, David.
David, can you confirm you're seeing a gamma presentation?
Yes.
Se quiser.
Bom, alguns pontos que a gente quer destacar aqui para a audiência, e começando por um dos principais pilares da gestora, que é o controle de risco. A gente, representando a Outubro aqui no Brasil, muito se fala sobre o robusto e rigoroso controle de risco da gestora. É um dos pilares que acompanha desde 1995, da sua fundação. Então, esse slide comenta um pouco sobre o nível de default do portfólio, né? Quando a gente pensa no portfólio de crédito, é natural vir esse questionamento para a mesa. Então, esse gráfico foi feito pela própria Oaktree para desenhar um pouco qual foi o nível de default dos mercados americanos de high yield e de senior loans comparado com o portfólio do Global Credit. Então, aqui a gente vê os níveis de default desses mercados. A gente tem, dentro desse material, o nível de default anual do Global Credit, que está na casa aí de 0,4%, tá? 0,4% anualizado, que se reflete aí num nível de perda, uma taxa de perda de 0,2% ao ano. Então, de fato, é um portfólio muito robusto, com controle de risco muito consistente, e de uma gestora que tem uma expertise muito longa de fazer essa seleção de crédito. O outro slide que a gente quer comentar, que eu acho que é um ponto importante para comentar sobre a estratégia, é essa combinação que é rara em portfólios tradicionais de crédito, que é nível de duration baixo com elevado yield, tá? Essa é uma proposta do Global Credit, permanecer assim. Você não vai ver o Global Credit com níveis de duration elevados em toda a sua história. Ele sempre fica aí na casa de 2 anos, no máximo 2 anos e meio, e hoje está na casa de 1,3 anos, então bastante baixo, justamente para navegar bem nesse cenário de incerteza da curva de juros, e com um yield bastante elevado, aí na casa de 10% em dólar. Então, um yield bastante competitivo com os principais ativos, inclusive comparável com o mercado de renda variável. E quando você passa isso para o veículo redeado, quando você agrega o Carry Brasil para esse carrego, você incorpora aí, vai para casa de 15% o carrego do veículo redeado. Tá? Então, acho que são 2 pontos sobre a estratégia que valem comentar aqui inicialmente. E aí eu passo a bola para o Rodrigo para comentar sobre mais alguns 2 pontos relacionados à performance.
Legal. Acho que os 2 pontos que a Marcela comentou, eles dizem respeito à estratégia lá fora. Eu acho que a gente sempre gosta de olhar todas as estratégias que a gente trabalha aqui no Brasil sob a perspectiva do investidor brasileiro. Então, esse primeiro slide aqui é um slide que está presente em praticamente todas as nossas apresentações, e ele é um slide que mostra a correlação tanto do fundo na versão redeada, quanto na versão com exposição ao dólar, a correlação de cada um desses 2 veículos com os principais benchmarks brasileiros nos últimos 12 meses. Então, a gente pega uma janela suficientemente grande aqui, uma janela volátil, para mostrar exatamente nesse período que foi bastante turbulento de mercado, né? A gente pega uma parte de 2022 e uma parte de 2023 aqui, e mostra como é que os 2 veículos, né, nas 2 versões, são extremamente descorrelacionados. A gente sabe que para ter um portfólio verdadeiramente diversificado e eficiente, você precisa buscar essa descorrelação efetivamente, né? E o portfólio do Global Credit consegue entregar isso nas 2 versões. Chama atenção, principalmente a matriz que está do lado esquerdo, que é a versão redeada. Então, aqui não tem nenhum fator de descorrelação vindo do câmbio, por exemplo. Aqui é 100% descorrelação advinda da estratégia, tá? E aqui é só uma atualização, acho que a gente tem bastante parceiro de distribuição do fundo na linha também. Aqui é para passar um pouco dos resultados, tanto da versão redeada quanto da versão com exposição ao dólar, nas principais janelas. A gente trouxe aqui porque, de fato, tem chamado bastante atenção. Acho que tudo isso que o David comentou de análise do mercado e visões que ele tem a respeito do mercado de crédito estão sendo implementadas na estratégia e estão rendendo resultados muito bons, principalmente nos últimos, digamos, 12 meses, né? Eu acho que a Marcela comentou do carry super atrativo que tem o fundo, e mais uma vez a gente vê o carry sendo refletido em bons resultados em períodos recentes. Então, como eu disse, eu faço um destaque aqui para os últimos 12 meses, então uma performance do fundo de quase 20%, contra um CDI de 13,44%. Então, aqui a gente já destitui um pouco de um dos principais mitos que a gente encontra no mercado, que é renda fixa global não é competitiva com renda fixa local, e isso não é verdade. Aqui está a prova, principalmente nos últimos 12 meses, uma performance muito boa do fundo e acima do CDI. Então, um excesso de retorno bastante interessante. A versão com exposição a dólar, a gente, na verdade, nem trouxe aqui nesse slide, mas ele tem a mesma performance da estratégia com o fator de exposição cambial embutido nos resultados do fundo. Tá? Tá bom, na verdade está nesse slide aqui, desculpa. E aí com isso é exatamente o que eu falei. Então, aqui a maneira que a gente gosta de utilizar, a maneira como a gente gosta de olhar, não é nem contra o CDI, a gente coloca o dólar aqui para comparar, justamente para a gente poder entender o que foi o principal driver de retorno para o fundo, né? Então, aqui a gente pode ver que nos últimos 12 meses a performance está próxima de 4,5%, mas o dólar andou para trás 7,4%. Então, o fundo não só ele conseguiu mais do que compensar o retorno negativo vindo do câmbio. A única ressalva que eu faria aqui ao olhar esse slide é que, para qualquer prazo que a gente olha aqui nessa tela, são prazos razoavelmente curtos para a gente analisar a importância de ter um investimento dolarizado na carteira. Então, a gente sempre gosta de reforçar aqui que, apesar dessas janelas mais curtas, nessas janelas mais curtas, o dólar ter prejudicado um pouco o retorno dos fundos, a gente acha que é um fator de diversificação interessante que pode caber na carteira de investidores brasileiros. Tá?
Só um ponto que eu queria trazer aqui, antes da gente entrar no Q&A, não sei, desculpa te interromper, deixar o convite para todo mundo que está nos acompanhando, conhecer o site da Gama, entrar no site da Gama lá, você vai encontrar bastante informação sobre performance, mas não só relacionada aos produtos, também muito material de research, muitos insights que a gente recebe, tanto da Oaktree quanto de outros gestores que a gente tem aqui. Então, eu deixo o convite para vocês conhecerem o site, www.gamainvestimento.com.br. Então, fica aí o convite para vocês acessarem. Inclusive, os memos do Howard a gente coloca lá, os memos traduzidos ou originais estão todos lá para vocês acompanharem.
Boa. Eu acho que com isso a gente pode entrar dentro da sessão de Q&A. Reforço aqui, a gente até algumas perguntas no chat. Fiquem à vontade para fazerem perguntas e explorarem assuntos que não foram cobertos na primeira sessão. A gente vai voltar agora para o inglês para dar início à sessão de Q&A com algumas perguntas que já chegaram. David, beginning the Q&A session here, I think the first question I have, we just shared some slides with the attendees regarding the performance of the local feeder fund. And we can see some expressive results, especially on the 12-month period. If you don't mind, can you explain a little bit and go into the performance attribution? What has been calling the attention in terms of performance? We know the global credit is composed by 7 different credit classes. Which of those classes are outperforming in the past 12 months?
Sure. So a few things that have been driving performance. I think the biggest thing was, as we talked about at the beginning of this webinar, our view has been kind of higher for longer for a little while now. While the market was convinced rates were going to come down, we really didn't agree. And as a result, we started moving into floating rate debt, because if you looked at the yield on floating rate debt, the interest rate curve, when you factor that in, made the debt look less attractive. We thought the curve was wrong, and so there was a bigger yield to be earned for longer. And so we started moving into loans, into CLOs in particular, and those have been driving very solid performance, because as yields have stayed higher, you've got loans giving you double-digit returns and CLOs giving you kind of even better returns. And so that's been a big driver to performance. The other thing, frankly, is when you go into the loan market, you're going into a market that is riskier, right? And we can talk about why, but really the simple version is that leveraged buyouts, which tend to be the riskier deals of the market, have gravitated more towards the loan market for financing. But since we can rely on our credit selection, back to kind of the conversation we were having earlier, we felt very comfortable going into a market that was riskier, being able to rely on safer investments. And so that gave us the comfort to go into US loans, giving us in US dollars a 10% return year to date, European loans giving us a 13% return year to date, CLOs giving us a 17% return year to date. And so those investments, I think, have been the big stars. If you fast forward to today, I think the natural question is, okay, are you still doing that? And I think that what we're starting to do is pivot more towards what we like to say is the core. And so in our products, as you mentioned, there's 8 different products we can invest in, bonds and loans being the core and everything else being our alpha strategies. And right now, what we've been saying is that we've got a yield in US dollars north of 10%. And so with that, I think that we don't really need to be heroic. We don't need to be reaching for risk. Right now, it's more about protecting the coupon. And so we've been leaning towards the core. Again, also because, as we talked about, if you believe in higher for longer, you like owning floating rate assets that are going to give you a higher yield for longer, but that also means these credits are paying higher interest for longer. Their cash flows are going down, their free cash flow is going down, their liquidity is getting eaten up, and you have to start to worry about credit. And so we've been a lot more focused on quality right now and keeping the quality higher. So for example, my favorite trade at the beginning of this year was a double B CLO. Double B CLO is this great trade because if you look year to date, risk in the market has really been the star. It's been a risk on market. And so in high yield, for example, triple C bonds are up over 13% year to date. Again, this is all in US dollars. But for me, to chase the risk of a triple C, if you think the economy is likely heading into recession, is not very attractive. And so we've been leaning away. But what I've been able to do is say, well, I can buy a triple C bond with a 14% yield, or I can buy a double B CLO with a 14% yield. And the double B CLO is a diversified portfolio with meaningful subordination to protect your downside, whereas the triple C bond is one idiosyncratic credit that generally needs to grow into its balance sheet. And as we talked about, I think you're going to see a lot less growth because the money to fund that growth is much more expensive. And so I'd much rather buy a double B CLO over a triple C bond. It's a safer way to get the same income. But now you fast forward to today, and I can buy a triple B CLO, which is even safer at about 10%. And that's pretty good. And so we've been leaning more towards quality in that regard. So loans, bonds, and triple B CLOs being kind of our favorite place to deploy. But that floating rate aspect, having our duration low, our duration is only 1.3 years, but having our duration low has really been driven some very solid performance. You may remember at the beginning of this year, all the Wall Street strategists, all the experts on Wall Street go around to tell everyone how they should position for the year. And I always like to hear what everyone has to say. And so they generally all come into our office and we'll sit down and talk to them. And the favorite trade of pretty much every strategist on Wall Street, which I guess is probably the first sign not to do it if everybody wants to do it. But the favorite trade was to buy investment grade debt. That was their pitch to everyone, was you can get 6 to 7% out of investment grade debt. We're worried about a recession back at the beginning of this year. You may recall it was a hard landing everyone was worried about. And so they were pushing into investment grade where defaults were basically going to be zero, and you didn't have to worry about that. What people missed was that investment grade, while it's not a credit bet, you don't have to worry about default risk, is a massive interest rate bet. And interest rates went up, and so now investment grade has been negative for the second year in a row, which is quite rare for investment grade. And so those kind of dynamics we were able to avoid by keeping our duration low. That was a big driver of performance.
Great, thank you. Just one more question before we jump into questions related to the outlook or the credit market as a whole. Just one more question about the portfolio itself. I mean, we know that you guys analyze different credit classes in the portfolio with a gigantic number of holdings to analyze. How does the process of credit analysis work, both at the asset allocation part of the portfolio, deciding which size each credit class must have in the portfolio, and also on the bottom-up credit analysis? How does it work in general terms?
Yeah, so it's a great question. I mean, this is kind of the key differentiator, I believe, for Oaktree versus others who do this, right? So our multi-strategy product, our global credit product, is a combination of all these strategies, 8 strategies that have all been around for over a decade. So Oaktree has been doing these strategies for, in some cases, 3 decades. And so each strategy has a portfolio that they run, and they run every day. And so we go to each portfolio manager and effectively say, hey, I want you to come back to me with your favorite ideas, your highest conviction names that I'm going to put in this portfolio. But the key is nothing goes into global credit that is not already owned, vetted, and invested and monitored by these existing strategies. So in order to do this right from the credit perspective, we've got effectively a team of 150 analysts that we're leveraging across our platform, from loans to bonds to convertible bonds to emerging market debt and so forth, vetting these credits every day. And so from the bottoms up, we have our process. We call it our credit scoring matrix for vetting credit, but we go through every name and vet each name. But most importantly, we reassess that name every quarter because the world changes. So, you know, sometimes you can say, hey, I think I got the thesis wrong and need to revisit, or I got the thesis right, but now it's no longer applicable because the world has changed. I need to acknowledge that too. And so every quarter, we have these 150 analysts reassessing the investment thesis on every name. And that's how you stay in front of changes in credit to make sure you're picking credits that work. From the top down, we have the portfolio management team. So that's myself, that's our CIO, Bruce Karsh, that's our head of performing credit, Armin Panosian, and Wayne Dahl and Daniel Poli. So all five of us are basically looking at credit all day, every day. And we will sit down with a team of portfolio managers that sit on our investment committee that support this product. And regularly, we meet with them every other week to talk about where are they seeing value. And we can take that into account when we make a decision on asset allocation. So the asset allocation comes from the top down, with all of us looking at markets and seeing where we see value. And the credit selection comes from the bottoms up with a team of basically 150 analysts. You think about it from a profitability perspective, the most efficient way to do this would have been for Oaktree to pick 10 people, put them in New York City and say, go buy whatever's cheap around credit around the world. And we could have done that, and Oaktree would have spent a lot less money on this product, but they would have had a lot worse performance. And so we believe in long-term investment in products and credit. And so we believe to do this right, to keep our default rate as low as it was, and I know Marcelo went through the default rate earlier, but to keep the default rate low, you need 150 analysts so that you can really be monitoring these credits regularly and make sure, as we talked about before, that you put yourself in the credits that are just going to redirect their growth capital into the balance sheet, not in the credits that the balance sheet is broken.
Thank you, David. And I think we can, this is a very good question that we always receive here, and I think we can relate, if you could do this, with the maturity wall that we are approaching, if you could comment on that, and how are you positioning the portfolio looking forward? How is this going to, how you could stand out compared to other managers?
It's a great question. So when we talk about maturity wall, used to be for a while, people would just say, well, there's nothing to worry about. Because what you had with the maturity wall is during COVID, central banks around the world flooded the market with liquidity, basically to keep the world from shutting down. When they did that, they brought rates so low that everybody rushed to refinance. You had lots of companies saying, well, I wasn't going to refinance for 2 or 3 more years, but I'm going to do it now because it's so cheap. And so they pushed this maturity wall out by refinancing early. And so when you look at the markets, loans and bonds combined, you've got less than 10% of the market maturing through the next 2 years. And so that means the world could end tomorrow and over 90% of the market doesn't have to answer to it for at least a few more years. And at that point, we may or may not be in a very different market. And so the market became very complacent, saying, well, I don't have to worry about problems because there's no maturity wall. And so I can just go chase risk. It's another reason why, as we talked about earlier, risk has been the favored bet of the market. And we found a way, as we talked about, to outpace the market without having to take that risk because we have so many other levers to pull. But when you look at the maturity wall, what you have to be really careful about is the maturity wall really picks up in 2027. That's when it really jumps. But nobody refinances on the last day. The math of fixed income security, for example, will assume yield to worst assumes you refinance on the last day because you're doubling your coupon and you're trading below par. But while that's the math, that's not reality. If CFO waits the last day to refinance, they could lose their company because they were playing games with their coupon, and that's just not prudent. And so in my career, I've usually found most companies refinance 2 years in advance. They refinance just to move on and get back to running their business because most CFOs also don't watch the markets very closely. They're busy helping to run a business. But you remember, my career has been mostly in a falling rate environment. So you refinance 2 years early, there's an incentive to do that because rates were lower. Now rates are higher, so I think it's more realistic to assume 1 year. When you get to the last year, you don't want to refinance, but you have to. So you bite the bullet, you refinance so that you can move on and go about your day of running your company. So if you have a maturity wall in 2027, that means you refinance in 2026. Now, the market's forward-looking, so if you refinance in 26, that means in 2025, the market's going to look around and say, hey, who do I think can refinance and who can't? And they basically create what we call zombie bonds and zombie loans. So zombie loans or zombie bonds or credits, they're not going to go into default until 2027 when they hit the maturity wall, but the market knows it's inevitable. The security will drop to 50 cents on the dollar or lower, and you'll be stuck in it. There'll be no liquidity because no one will buy it from you. And so the impact of the default happens in the market before the actual default. And why that's important is 2025 is not that far away. And by the way, if you're early in 2026, let's say you have a maturity that's early in 27, so you have to refinance early in 26, it might actually be late 24. Where the market decides, hey, let's start looking around. And so it's right around the corner that the market is going to start looking around to see who can refinance and who can't. And so many of these companies that we talked about before, the narrative has been, well, they'll be able to refinance because by 2026, rates will be lower. And we don't have to worry. And I always like to joke that hope is not a strategy, and yet the market is resolute in using hope as their strategy to keep everything propped up. And so I think people are finally coming around to the reality of, hey, rates may not be lower. And if they're not, some of these companies can refinance, some have no hope of it. And so that to me is where you're going to see the separation of the Oaktrees versus everybody else, is being able to pick the ones who can refinance and avoiding the zombies.
Great, David. Thank you. One further question about the markets. One of the attendees asked if we can see 30-year TIPS paying real rates around 2.5% in a sustainable way looking forward. Do you think this is feasible, or this is something of more of a short-term trend in the market?
You know, I think rates have gotten high right now. If you look at rates where they are, and the concept that you know, you're going to have to keep rates here in order to push inflation down to 2.5%. You know, I think that, you know, it can stay here for longer than the market expects, but eventually the system is somewhat dependent and designed on rates being a little bit lower. And the reality is, if inflation gets down to 2%, say if they get all the way to 2%, eventually you can't have rates above inflation. That constricts an economy, and you're going to have to bring rates down a little bit. And so 30 years away is a long time. I think you could see things come down a little bit. The biggest question to me is going to be, you know, 2% is this magic number they keep talking about, but there's really no math behind that. If you talk to the Fed and ask kind of, hey, why 2%? You know, can I see the model as to why 2% is where inflation needs to be? There's no actual math behind that. It's somewhat arbitrary in the goal. And so could that 2% really be 2.7, 2.8, and they call victory? It's possible. And if that were to be the case, then yeah, you could see real rates hovering around that area as well. And so a lot of this is going to be dependent on at what point the Fed decides to claim victory. And the challenge is going to be that if they claim victory too early, they lose credibility. So in reality, they could probably claim victory at 3%. And I'm not sure that would be that meaningfully punitive to the economy relative to 2. But if you did 3, I think you lose credibility. And so I think they've kind of cornered themselves into needing to fight for something at 2. But could 2 become 2.5 and that's close enough? Yeah, it could. And so I don't think it's crazy. But if I had to pick, I'd say that, you know, between now and then, you probably see it come down a little bit.
Another question, David, we received from the audience is regarding what are you excited about looking ahead? You mentioned the drivers of performance of the last 12 months of this year also, but looking ahead, anything you're more excited, you're more positive about, any asset class?
So what I'm most excited about is this opportunity. So during COVID, some of the best deals that we did were what we now call rescue financing. Right, so rescue financing, basically you had companies that needed a liquidity bridge to get through quarantine, and they were willing to pay dearly to get that option to stay alive. And those were some very good risk-adjusted returns that we were able to achieve. My favorite was Carnival Cruise, I like to bring up, where we provided some liquidity to the company to keep it alive, and we were able to get secured debt that was at the very top of the balance sheet with a loan to value of 25%, but get a 14+% return in US dollars. And so very attractive. and a very low risk, in my view. If you look forward over the next year or so, I think we're going to see another wave of that, but for a different driver. Obviously, I'm not predicting another COVID. However, in 2018, 2019, we saw all these leverage buyouts. And the model of the private equity sponsor a few years ago was, I'm going to buy something and it doesn't matter what I pay. I can pay anything I want because I'm using free money to finance it. I just need to win the deal. So you'd see multiples go higher and higher until they won, and then they would buy it with free money and have the company just pay off that free money, and that's how they would get their internal rate of return. Well, now all those deals turn out to be, well, by the way, I should add, all those deals are generally financed with floating rate debt. And shockingly to me, if you look back, most companies did not hedge, which, in hindsight, obviously they should have, but they didn't. So about 25% of the market's hedged, 75% was unhedged. And so when rates start floating higher, they actually had to pay the higher rates. So now I think you're going to see a wave of deals where private equity sponsors are looking at their companies. Some will be private deals, and a lot, but a lot I think will also be public, like Carnival Cruise was a public deal, where the private equity sponsor is looking at the prospect of throwing the keys away for the company. They're going to lose the company. And so they will come to the market basically saying, I need a couple more years of runway, and it's optionality, right? To see if I can make this company work, get it to improve. And optionality always accrues to the benefit of the equity holder. But if they're looking at throwing away the keys, I think there's going to be the prospect to say, look, I will finance this. I will give you 4 or 5 more years of runway, but you're going to have to pay dearly for it. And I want to jump ahead of everybody else in the balance sheet to do this so that I'm really safe. And from the prospect of the sponsor, what do they have to lose, right? They're either going to walk away and lose everything, or they can allow you to finance some runway. And so if you can structure that so that you have very little downside, but actually are getting paid very well, to me, these are going to be, on a risk-adjusted basis, some of the best opportunities we've seen in the last 10 years, where a lot of people desperate for money all come to the market at the same time. You don't usually see that. There usually needs to be some sort of event that causes the economy to unwind, like a COVID, to see that. But this one, the economy could be coming out of trouble. We're heading into recession. We could very likely be coming out of it. But because of where rates are, there's likely going to be a lot of companies that have to all come to the market at the same time, and that creates great opportunity.
Great, David. Thank you so much.
Thank you, David. I think we're done with the questions. Everyone, I'm going to switch back to Portuguese now, David, just to make the final considerations here, but I would like to thank you very much for being here with us today again.
Pleasure.
Very helpful and insightful. Pessoal, se ficou mais alguma pergunta, por favor, entre em contato comigo ou com a Marcela. A gente pode entregar essa pergunta diretamente na mão do David para ele responder. Eu queria agradecer a presença e participação de todos e queria reforçar a informação de que a estratégia do Global Credit está distribuída nas principais plataformas aqui do Brasil, tanto na versão redeada quanto na versão não redeada. Então, para acessar a estratégia é muito fácil. Se vocês precisarem de alguma informação ou o caminho exato, podem interagir tanto comigo quanto a Marcela ou qualquer pessoa da equipe de investimentos da Gama ou do HMC, e a gente vai ficar super feliz em ajudar vocês. Mais uma vez, obrigado pela presença de todos e a gente se vê na próxima. Thank you, David.
Thank you. Bye.
Thank you.